Uh, and now for all the attendees, and again, we're incredibly excited. You've got a wonderful, wonderful event ahead of you here today. As you have questions going through this, we expect a lot. We'd appreciate if you could just raise your hands and just let us know anything that we can do to answer or address any questions that you have. And with that, so I'm Andrew Glaze, CEO and founder of WellStack, and today we're going to be teaching you all about the foundation and fundamental lessons of how you access capital. I'm joined today by my good friend and colleague, Greg Blake. First things first, a bit about my background, how I came to be here, and how WellStack came to be as well. I went to West Point, served in the Army for 5 years at Fort Hood with 1st Cav Division Field Artillery. After that, went to Columbia for business school, where I was a recipient of a Merrill Lynch fellowship. They paid for business school, gave me the chance to work as an investment banker, then worked at MS Capital. I left Merrill, started my own firm, grew a fund from 0 to $40 million in capital, and then went to a $500 million family office as one of 2 investors, primarily focused in the media and tech space, and then went to a private equity firm, Standard General, with $2 billion in capital, where I was focused on media, private equity investments. I serve on boards. Through my time at Standard General, I served on the board of National Cinemedia, which did $450 million a year of revenue. It's all of the movie advertising for AMC, Regal, and Cinemark. I also serve on the board of MediaCo, which is a media conglomerate. They buy and sell legacy media assets. Earlier this year, we sold $78 million of outdoor billboard assets to Lamar. And then I left Standard General and created a platform, WellStack, really, which is the bridge between the veteran community as well as the Wall Street and capital. And with that, I'll turn to Greg. Great picture there, by the way.
Thanks. I could use an upgrade. Great for everybody to be here. Appreciate you joining us. Just my quick background. I am a 94 grad of the Naval Academy, got commissioned in the U.S. Marine Corps, and which took me out to after training and such out to Camp Pendleton. Did 5 years and didn't want to leave California, but was sort of ready for my commercial career. So I worked in various technology startups in Silicon Valley for it started when tech was booming, and it stopped not too long after things had melted down in the early 2000s. But what I wanted to do is I made a pivot from that, because I had gotten to know and gotten to work with alongside a lot of really, really successful business owners in Silicon Valley, who most of whom had one thing in common, which was they were good at making money, and they also had in common that they weren't great at keeping it or being able to leverage it for their own personal happiness. So pivoted into wealth management. I've been at a few different firms. I started with AllianceBernstein, ultimately with a firm called United Capital, which we were acquired about 3 years ago by Goldman Sachs, where I now run an office in Bethesda, Maryland, just outside of DC.
Awesome. I've had the chance to connect with so many great veterans in building WellStack. It's really been one of the tremendous pleasures of the last couple of years. Greg is great. He's just an awesome Marine. As there's so many Marines, really dependable, really committed to helping, really committed to sharing resources with the veteran community. And I found that incredibly helpful for WellStack and its customers, and really wanted to really help expose a lot of the great things that Greg is doing within Goldman to the broader veteran community. And then we'll be joined by Charles York at some point in the call. Whenever Charles is here, feel free to come forward and give your bio. And then
he's actually on, Andrew, but he's not showing up as a presenter.
Oh, really?
Yeah.
Now, let me shoot you a quick text. All right, and then before we kick it off too much, I see a question here. Oh, it's already been addressed. There, Greg's already handled it. Greg, why don't you talk a bit about the Goldman Sachs partnership here and some of the ways that we work together and some of the ways that you deliver Goldman's tremendous resources to WellStack's clients. Why don't you also, we've got a wide array of veteran CEOs here. Some are running large corporations, some are just getting started. Why don't you talk a bit about Goldman Sachs and what the bank does in aggregate, give them a quick overview, and then provide a description of how we work together.
Yeah, absolutely. So, we've been around a little over 150 years, started out as issuing commercial paper on Wall Street. And one of the our original founder, Marcus Goldman, was one of the pioneers of being able to basically loan to non-bankable companies. And ever since then, that's really been, we've figured out ways to be more and more of a part of these business owner and entrepreneurs' success, right? And it's obviously mostly centered around financing, to the point where now we are a bank, sort of a non-bank bank. We've got a traditional banking arm, we've got private bank, we've got a merchant bank. We're one of the largest M&A advisors and general investment banks in the world. And the idea is, and so we try to start as early partnering with business owners as we can. So the idea is we usually will engage on the earlier side with someone where they can invest with our wealth management business, which is the part of the business that I'm actively in, at about $1 million of helping them with their IRAs and sort of early savings, up to on the other end of the spectrum, taking their company public for them, doing bond issuances and everything in between. So we're able to do private lending. We're able to issue securities in the market. We're able to do the actual transactions and so on. So the way that we partner with WellStack is that WellStack has relationships with a lot of veteran-owned business owners. And what's hard about Goldman and all those things that you see on this slide is that it's just a bit hard to navigate, right? So if Andrew we're not a partner and were to just sort of reach out to me, it's generally more difficult. We have since, in order to be able to help people through that sort of entire life cycle of their finance and their business success, we have something that we call 1GS, and that's what Andrew is partnered up with, where if he has something he needs to help somebody, a business owner, for capital, whatever it might be, he comes to us, and our 1GS is able to actually internally take a look at what the transaction would be necessary. If this is somebody who's not already have a relationship with Goldman, a more comprehensive relationship, sometimes a transaction is the sort of step one into meeting us before we're able to do a lot more things for them. But we'll take a look at it, and our team here with what we call 1GS will take it to the investment bankers, to the merchant bank, to the private bank, and everything. And we'll be able to look at all the possible options for us to do it. And if it's just too small for it to make sense for us to do, or something that we just can't do or don't find attractive, we leverage a huge network of firms where we can probably, if we're not going to do it or we're not able to do it, we'll find somebody who can. And that all sort of comes to you through Andrew and WellStack.
That was a great summary, and I really appreciate it. It's great that you mention it. I was an investment banker at Merrill Lynch, and the same framework and rules apply. It's just really hard with the way that investment banking works for you to help businesses doing below $200-300 million in revenue when you're sitting at a large bank, and so you're prevented from working on those deals. And so what we built with VetCap, the Veteran Capital Access platform, is automation around that, so that you're able to get so much more bang for your buck as an investment banker and using this platform and tool, and that allows you to work with earlier stage businesses and to do it really effectively and efficiently. And so it's good to know that all those nights working until 3 a.m. have given me the perspective and ability to automate so many different opportunities there. Today we're really going to be delving into how you can get financing for your business. And so we're going to lay a very steady foundation. I myself am a chartered financial analyst, which is a absolutely torturous series of exams that you take over 3 years with a 20% or so pass rate. That's extremely grueling, and it leaves you with a very, very deep understanding of all manner of corporate finance. I'd say the CFA actually did more to teach me about corporate finance than Columbia Business School, but all of those have come together to give me a really good foundation that I'm able to share with you, the veteran entrepreneurs, and I'm very excited to do so. So we'll be talking about the why it's so important for you to have access to capital. We'll really look at debt and equity, which are the two primary means of which you get access to capital. What you should think about when you're selecting your options, the pros and the cons. Really figure out the cost of capital, which is ultimately the primary metric that you should be using. And then we'll talk a little bit about risk and flexibility. Of course, as we're going through this, Greg and I will be answering and addressing questions back and forth. As we talk about financing options where Goldman participates, then Greg will be able to share a bit about that. We'll also be talking a little bit about philanthropy. Goldman is very philanthropic, and we'll get a chance to learn a little bit more about, for those veteran entrepreneurs who are working on 501(c)s or charity related businesses, how they could potentially partner with Goldman as well. And with that, let's really delve into it. So, you know, I see a lot of things as a veteran CEO, and I often see that many of us become incredibly successful through hard work and through grit. But in many instances, we're lacking a knowledge base as far as what's available and what's out there to get the capital that allows you to take your plan faster. So what's great is we don't let it slow us down. We keep going, but we take a harder road than we otherwise would need to. And so it's really exciting to help get so many great veteran entrepreneurs the tools that they need to scale and succeed and do it faster. And so it enables you to do M&A. As we mentioned at the start of this call, I'm going to Deal Max. There'll be 3,000 M&A professionals there talking about, we're talking about close to $700 billion of M&A transactions last year. Were worked on by the group of people that will be in this Las Vegas conference. And so you have the ability to buy and to grow via acquisitions using capital. And then, of course, it provides stability in helping you accomplish your plans. And it's so much harder to get where you're looking to go without it. Now, here's where we get into a little bit of the meat of the lesson, debt and equity. And so we'll talk a bit about what are the different components here and what makes them different, what makes them unique. Now, there's a lot of different flavors of each within, but the general framework for how debt works is pretty consistent across all debt instruments. And the same, for the most part, can be said with equity. So with debt, you borrow money, it must be paid back. It requires repayment of the principal plus interest. Now, that interest can be a set amount that's known from day one and doesn't change. It can be variable, tied to typically LIBOR or other market rates. And what we're seeing currently in today's market is a lot of volatility in those underlying rates, and that's creating a lot of volatility for underlying businesses. That's a great example of instances where people are happier to have fixed rates. For myself, I have a mortgage. It's a fixed rate mortgage. I got in 2021 with a VA loan, 0% down. And I'm very happy I have a fixed rate mortgage at 3%. Market rate was 3% at the time. And so fixed or variable would have been right around there, but I got fixed. And now with everything changing, variable is so much higher. And so it's similar for business loans. And so loans typically require collateral, and then there's going to be a regular, well-known schedule as far as what payments are due at what time. Now, the key advantage of debt, and there's a couple of key advantages of debt, but number one is there's no dilution, there's no loss of control. And so 9 times out of 10, equity stories end up without any major issues amongst the shareholders. I think, maybe that's 8 out of 10, 9 out of 10. The majority are, but that 1 out of 10, man, it can get really challenging when you have equity and someone else has equity and you're looking to do things and you're not in agreement. That 1 out of 10 can be a doozy. And so you avoid those scenarios entirely with debt. But what you do have is a financial fiscal responsibility to make the payments, or potentially you can have your company go away. And so this is really, really important. Can't say enough about the potential downside here. And so you need to be mindful of it. And so the lenders don't want that outcome either. And so they're going to do their very best to not lend you more money than you could use to hurt yourself. And they use things like covenants and debt coverage ratios and other things to make sure that the business can support the debt. But it is important that you understand that the penalty for too much debt and not repaying the debt because you're unable to do so is the potential loss of your business. And so with that, we'll take a quick pause here. And Greg, maybe you can talk about some of Goldman's products in the debt markets. I know that you guys are doing all manner of things on the fintech side. Obviously, your investment banking side. Do you have a small business loan? Does your wealth management group provide access to small business loans? Could you talk a little bit about those?
I actually don't. I need to find the answer out to the small business specifically to SBA backed loan. But we've got a variety of ways, and I will get back to you on that. I think the answer is yes, but I want to absolutely verify. When we're lending, it's typically pretty large, right? When we're making traditional business loans, and we can do that a number of different ways through a traditional bank off of our balance sheet, just a traditional bank commercial loan. We also run a lot of private debt funds that we can lend from within, and or we loan money out from the basically a pool of capital, which we call the merchant bank. So there's a variety of different ways, and we can also do conduit financing. It's not currently particularly in favor, but sometimes we will make loans. Particularly, it's very typical in the commercial real estate market. But that's when you see when you're investing in a securitized grouping of various commercial loans. So there's a variety of different ways. One note I just wanted to make about this is I think a lot of veterans, frankly, I've found a big commonality is they just don't like debt, right? Don't want to owe anybody money, want to be totally, it just doesn't feel like something that they would want. The reality is for a business, there are very few businesses don't become successful without some leverage, right? So that leverage is okay. And just a quick little story. One of my clients, very, very successful, very wealthy person, is probably net worth about $125 million. But then I met with he and his wife is stressed out because they're basically unable to, they just don't have money. She's afraid that their checking account is going to run out. And the answer is he hates debt. But he also doesn't want to give up control of his company. So you can't spend equity in your company and or commercial real estate properties. You got to get the cash out somehow. And this guy's gotten into his 70s. He's not going to actually be able to participate and enjoy and live life as an affluent person unless he takes on some debt. So we did that, and we actually have gone through and we've recapitalized all of his commercial real estate, all of his lines of credit against the business, and so on. And now all of a sudden he's actually able to live as a centimillionaire like he is. So, I would say on average, don't be afraid of debt. Obviously, there is a limit, and there's a right amount, and there's a workable amount, which is different for every business. But I do think there is a common veteran mistake to just say, I just don't want any debt.
I love that story. Join Goldman and become the envy of your friends is basically the underlying tale there. And so, but no, 100%. I think that for many of our mid-sized veteran-owned businesses, the merchant bank could be interesting. Could you talk a little bit more about what a deal with the merchant bank could look like for a veteran-owned business? Let's say doing 20, 30 million of revenue and looking to potentially acquire another business or looking for expansion. What does that deal and what does that process look like?
Yeah, so the merchant bank is basically instead of selling a piece of your company in the public markets, it would be making a direct investment with a grouping of private investors. So inside of from a limited partnership. So it's smaller. You don't have to do a big costly raise, but basically we would just look at the opportunity, look at that business inside and out. We would underwrite it and then make an offer on the transaction based upon how much you wanted to you wanted to capitalize, whether it was debt or equity. You can certainly do debt and equity deals from within the merchant bank.
It's great, fascinating. And so, you know, as always, every time we spend time together, I've got more ideas for ways we can creatively structure deals to help veteran entrepreneurs. Let's talk about the equity side of the table. And so with equity, you raise capital by selling shares, stock in your company, and you give a portion of ownership and control to investors. And generally, economic ownership and control tend to go hand in hand, but not necessarily. There are things, there are different classes of shares, which you can do even as a very early stage, you know, 2, 3, 4, 5 man company. You can set up that there's different classes with different voting rights. That adds an element of complexity, but I can tell you that it's much better to have done it before you need it than to be looking at going public and trying to add B shares. And I've seen everything in the gambit sort of thing. And so something to think about. Now that can be especially important for us as veterans because we have the potential to deliver a veteran-owned business status to our companies. Now that requires generally more than 51% ownership. Again, economic ownership and control generally are aligned, but you can potentially shift that and have 51% voting control, but not the economic ownership. And potentially doing that may give you access to capital, you know, again, depending on what the deal is structured to look like. Now, you want to ensure that it's going to pass the smell test. I very famously, it was the U.S. government was giving out satellite rights to diverse owners, and Mario Gabelli's Gardner like won the bid, and that made the front page papers, and that didn't smell right. Right? Technically, his diverse Gardner owned it, but it didn't feel right, and so you never want that situation. But you do have the opportunity to disaggregate economic ownership from control in order to get a veteran qualification. Now, generally, the way it's designed to be, the economic owners get the company's profits. Depending on the structure, you may get different tax advantages. C corp different from S corp, different from LLC. But generally, the profits are supposed to go to the owner either in the form of dividends or appreciation. That means the business has gone up in value, and then you sell it either in part or in whole. Now, getting equity is great for high growth companies which have limited cash. The challenges with equity is that it's very bespoke. Equity tends to be very bespoke. And so if you're raising credit, you're going to, and you're a cybersecurity company, or you're a government contractor, there's a lot of other companies that have raised up before, and companies that lend to them understand the process, and it's fairly commoditized. People know what they're looking for. They see it. Your name doesn't really matter. Your business only matters a bit. They're really looking at the metrics. They're looking historically, and they're making a decision on the creditworthiness of business based on what they're seeing. Equity is very different. It's very prospective, and it's very much, do I like and believe the story? It's a very different approach to it, and because of that, that means it takes longer, requires more, can require more involvement, more engagement, and going back and forth. And then we talked a bit about dilution. And so if you own 100% of your company today, and you go to someone, hey, I need money, I need $1 million. My company's worth 4 million. I'm going to give you, or 3 million. I'm going to give you a third of my company. You're going to give me $1 million, and I'm going to go make this company worth $1 billion. Take your $1 million, and you go. The person now has rights. He has the ability to impact some of your decisions. And the more equity that this person gets, the more control they get. 51% leaves you with majority, and you can do most of the setting the board, setting employees, manner of thing. But there's some things that require 66%, which is a super majority. And so as you're giving out equity, you're losing some of the control. Greg, do you want to talk a bit about, now I know your IPO practice is second to none at Goldman. And I've got a number of good friends, including Nicole Urban, who works in Goldman's tech IPO side. They're huge. What else do you guys do with equity? And then, can you think about how middle market companies could potentially leverage some of what you guys have available as well?
Yeah, so I mean, one of the places I would start is I mean, if you're going to look at equity financing, you like a lot of small business owners, if you've had no other reason to do evaluation, it's the first time you're raising equity, you need to know what the company is worth. And that can be kind of an intensive, rather expensive process. We can do that for you, just as like working with Andrew, just as part of the relationship with you. So it wouldn't be so extensive like a normal valuation, but it's a great place to start to give you a broad general idea before you start going through the process of raising. So sometimes I think when we're helping people raise equity financing, sometimes it's a strategic, right? So they're looking to actually bring in some talent that's going to add value to the company. And in that case, I think, typically our investment bank, we know who's out looking, exactly what they're looking for. And we're doing a matchmaking to find not only just the cash that you want to take off the table, but the right person. And I think that's a really big deal. And I think we're able to do that pretty good job of that because we are just sort of in every industry and pretty much know most of the companies. Another thing I think to think about when you're looking at equity financing, I know we're kind of focused a lot on sort of growth capital. But the other thing is that when you're raising capital, sometimes it makes some sense for the founder, as long as it is, as long as it's the right situation and isn't going to create a negative sentiment or something, is to take a little bit of chips off the table once in a while. Because if you wind up growing this very, very big company again and just live off the income, sometimes you may be shortchanging yourself and your ability to sort of enjoy the fruits of your labor. But two, if you wind up growing a very, very large company that you own 100% of, and you pass away, you've now left your kids with a 50% tax on the estate above a certain amount, and it's illiquid, right? So that creates a situation, if you haven't done some of the planning around with equity financing and being able to have liquidity in the company, it's a 50% tax at your death and creates a situation where they have to fire sale the company for a low valuation. So this is all. It all starts with just having people, and Andrew, and I think a lot of you have already partnered up with Andrew, just having somebody who understands all of the different elements of financing and capitalizing a company, and they mix with the personal needs and your family situation, and all of it's got to work together to make good informed decisions. So that, I guess that's my comments on that. And as far as like raising equity financing, we run our own internal private equity funds. So sometimes we may be able to actually be the provider of it by making your portfolio company if it's large enough. We invest in third-party private equity. So we're partnered up with a lot of smaller companies that will do that will also make direct investments. And then we're investment bankers, right? In that we're going out to make the one-to-one match. So there's a lot of different ways. And frankly, beyond all of that, I think people that do this for a long time, including Andrew, myself, and both of our colleagues, you just wind up knowing a lot of people, and you're able to bring some value by matchmaking, by finding the right money. And I can't stress that enough. Like finding the right equity partner, if you're going to start selling equity, is important.
100%. And so spot on. Goldman does a lot of things really, really, really well. They recruit some of the most competent people on the street, and they're ruthless to everyone but their clients, which is actually kind of what you want, sort of thing, oddly enough. And so it's great that we're able to introduce so many of the wonderful capabilities there and working together to the veteran community. And so we're going to go a bit deeper into pros and cons of different types of capital. When you think about debt, and with debt, we've got 200 allocators on the WealthStack platform, which include Goldman and 200 others. With debt, our earliest lenders will start when you're doing $10,000 to $15,000 a month in revenue. And our largest lenders, Ares, really doesn't like writing checks below 40, 50 million. And so we've got a full gambit all across it. And so you can start accessing debt capital through digital lenders as early as 100, 200,000 of revenue on your way up higher. And one of the great things about WealthStack, I get to watch and cheer on the sidelines is some of our clients have gone from $200,000 to $15 million in revenue over 4 or 5 years. You know, you just need the right start sort of thing. And sometimes getting that loan in that early stage that gets you ready for that key hire, those key resources are exactly what you need, sort of thing. And so as you look at it, you're going to focus on your interest rate, fees, dilution. Really, it's about risk, and we'll talk about how risk plays a role in this. And then flexibility. Now, there are some businesses that are as steady as you could be, and you always know what's going to happen there. That may be a local gas station or a newspaper, or it may be something really, really predictable. In other businesses, there's a lot of volatility. And so you have to think about how certain are you of the ability to make payments in the future as you contemplate what's the right amount of debt. Now, what that means is businesses that are very stable, and if you know, I'm old, forgive me, but if you remember the yellow pages, this is the most stable business, and because it was the most stable business, it was able to take, in some cases, 6 to 7 times turns or multiples of its earnings EBITDA of debt, because it can handle it. It's very stable. But some businesses that are less stable, say consulting or coaching, that have less certainty of revenue, those may only make sense to have half a turn, or they may not make sense to have any. Again, it really depends on the particular aspects of the business. And so, you know, looking at a specific example for a cybersecurity company seeking $2 million of funding, your options are going to be, and I come to this one a lot. That's probably why it's on the front of my mind. I see a lot of cybersecurity companies looking for $2 million in funding. So you're either going to be looking at debt financing, and so we've got a wealth of lenders that are focused in that space. Don't get mad, Greg, but B of A has got a really, really good small business lending arm. They're really good at lending there. And so, you know, different banks have different capabilities. They're really good at small business lending. They're really good at lending for things. You know, you've also got equity financing and looking at, well, what are the types of private equity or venture capital firms that like to invest in companies of my type, and then how do they structure those deals? Are there angel networks on the VetCap platform? We've got an RIA that only likes to invest in West Pointers. That's great. So we've got just a wide, I'm sure there's Annapolis RIAs just like that too. I just haven't run into them. Greg probably knows them, right? Sort of thing. And so we're able to match you up based on your attributes across that. And then hybrid is securities that have a blend of both. And so that could be convertible debt, that could be preferred debt. Now, family offices, which are affluent people, basically look for ways to grow richer, and they often may hire people to look to manage it in-house. Family offices love preferred deals, and so that might look like, hey, we'll lend you $5 million to finance this acquisition. You have to give us 14 or 15% guaranteed. If you don't, it converts to equity, and we get this percentage and this control. And here are some of the other aspects to it. And so it has fixed income like attributes, but also equity attributes. Hence the terminology hybrid.
And just to add on to that, Andrew, that's
What
by far, for the earlier stage in the crowd here, that's by far the hybrid option. That's what people are typically doing when they're doing their first round or their first couple of rounds, is a note that is convertible at a given price later into stock. And the reason for that is, frankly, it's you can't just sell equity to something that's very difficult to price, because you're just starting out. You haven't really demonstrated exactly what the price is going to be yet.
That's a really good point, Greg. Thank you so much for sharing that and elaborating a bit on that. The SAFE, which is a common framework that was made popular by Y Combinator over a decade ago, is a 4-page document that governs an investment. And as Greg mentioned, you don't set a valuation today. You basically effectively defer it, though you may set a cap and limitation on what that valuation may be. But this document, you know, amazingly enough, is used for tiny deals for $10,000 and massive deals for $20 million, and no one changes a single word of it. And so Y Combinator, in creating that, has saved entrepreneurs billions and billions in legal fees. But you have access to that. You can Google it, and you'll simply go to Y Combinator SAFE, and you can download it and immediately begin using that as a document to govern an investment. And many people find it really easy and effective to use. WellStack has used safes to raise capital ourselves, and so again, we're very familiar with it. So things to think about when you're choosing your financing option. And so debt, now you've got control, a lower cost of capital. You've got full ownership. Interest is tax deductible, and that matters now. It didn't matter. I mean, it still mattered when interest was 3 or 4%, but it really matters now. And so it can act as an effective tax shield. And so what I love to play, because I love M&A and I love strategic games, I love all the strategy. What I love to play is I can acquire a business, and then with the cash flow or with the new business, I can actually have it pay for itself, and the tax deductible interest aspect of how you finance it can be really helpful there. And so cons, you've got to pay the debt back, and there's additional financial risk because you do have to pay that debt back. There can be collateral requirements. Sometimes this is a personal guarantee. Equity financing. Pros, there are no repayment obligations. You don't have to pay the money back, and so you don't have to worry about that. Potentially, you get access to their network. You know, as I've really been on the inside of the financial engine in so many ways: banker, private equity, hedge fund, fintech. I've been all the way through it in so many different ways. And you know, I'll say that you don't usually get that much help from your investors. Now, that is not always the case. There are certainly instances. What you do get is capital. You get capital from investors, but very often these investors are busy rich people doing busy rich things. And so what they're not doing is picking up the phone 3 hours a day to make everything happen for you as is necessary. They may make a call or two once a quarter, and that call or two can be really, really helpful, but you shouldn't expect a lot of labor from your investment capital based on what I've seen. But that capital can potentially put you in the position to win. And it should also open up networks. You've got shared risk. The cons, you've got dilution of ownership, potential loss of control, and it is a higher cost of capital. We'll talk about loss of control because that is something I'm also very familiar with. I worked at a distress for control private equity firm, Standard General, which is the largest controlling shareholder of Bally's. That's a company that they were able to get for $75 million back in 2010 and built it up to Bally's, which is a peak around $7 billion enterprise value. They were able to get a tremendous deal on it because there were issues with the ownership structure. And so these ownership structures can create issues. Now, I've seen and frequently like to invest and benefit from them, but you should also be aware of the challenges that you're creating for yourself as well as your structuring equity. You should really think about it because it lasts longer and can be more painful than a marriage and divorce situation. And then again, we've talked about hybrid, which are going to be truly bespoke, very much driven by the allocator. A lot of family offices like it, a lot of sophisticated investors like it. Be careful. There can be ownership traps in there as well, but often it can, if you find the right partner, present a unique solution. Often these are earlier stage, as mentioned. Goldman and many other banks are not going to want to write large, or not going to want to write checks below 25, 50 million, whereas many hybrid structures will offer maybe $1, $2, $3, $4 million chunk size deals, and so it's a different investor set sort of thing. And also because of the allocators, they may get better protections, and because of those protections, they'll feel better investing in an earlier stage business. And so it's a two-sided coin. You can get really smart, good money writing smaller checks, but you end up having to adhere to a very bespoke, specific structure about how you use the capital. I can say sometimes it makes sense, but you want to certainly read carefully as you go through it. Assessing the cost of capital, I had to give one formula in here. This is the WACC formula. And so weighted average cost of capital, what it effectively does, it says there's a cost for equity, and that cost is high. People invest equity because they want to generate a return, and they expect to lose money in a lot of their investments. And that means that they need to make several 100% in some instances in some of their investments, and they have a really high cost of capital that's leading them to give you money. They want to make a lot out of it. But and you also got the tax impact of debt, and you're putting it all together, and what you have is a weighted average cost of capital. What it effectively means is the lower your WACC is, the better and more attractive investment is. Think of it this way: if you're running a store and you need $1 million of inventory so you can sell it for $2 million, you may go out and let's say your WACC was 40%, 50%. We'll make it easy. So $1 million WACC 50%. That means you're paying $500,000 a year to get that $1 million of capital to make the 2 million. Now, let's say you're able to bring that WACC way down because you're able to find tremendous debt financing, and all of a sudden, and you got the tax shelter, and now all of a sudden that WACC is 10%. Your weighted average cost of capital is only 10%. That same $1 million you had to spend now costs you 100K. All right, you sell for 2 million, you make 900K. You make so much more because your cost of capital is lower. And so your goal in general is to get the lowest cost of capital that you can, because that leaves you with extra cash flow as the owner that accrues to you, is a good way of thinking about it. With the understanding, of course, always that the more debt you include in a business, the more potential financial risk there is as well. And so there is a balancing act here where you're looking at your total debt over capital, your rate, your tax rate, the amount that you're going to have to distribute of your company to equity investors, and you're putting it all together to create a formula. This thing basically lives in Wharton textbooks, but it's a good framework for you to keep in the back of your mind. You want to certainly ensure your business gets there, but all things being considered, you want to maximize the equity ownership that you have when you do. And so it always makes me sad when I see an entrepreneur that doesn't know better with a great business that they're passionate about, pledging so much of their equity very early in the game because they don't understand the value of it, and they just want the money now to go do what they want to do. They don't understand. But that's what we're here for. And so lastly, we'll talk a little bit about risk and flexibility. And so what is the right debt to equity ratio? What is the right level of interest coverage? Going back to our retailer, let's say you're making $1 million of cash today and you're looking at acquiring another business, you can say, well, you know what, as long as my total interest expense is under $500,000, I know very easily I'm going to be able to support it looking at my historic stable cash flows. This is without even factoring in the additional cash I expect from the new business. And so there's a conservative aspect to it. You can look at your business, look at the cash that you've delivered, look at the cash you expect from if there is an acquisition target or if there is growth, and you can blend those together and ensure that you've got a good, healthy cushion between what you're going to have to pay and what you're going to generate, right? And so as you think about that, that says, well, you know what? I think I'm going to need 2 million based on what I'm seeing and the rates I'm seeing. I can do 1 million in debt, and I can actually defer a little bit and get maybe $500,000 of equity from here, put it together. I've got a lower weighted average cost of capital. I've got the benefits of both. And so you can create a bespoke, specific financial solution for yourself. I'm going to switch over to the VetCap platform and demonstrate how you do all of this there. Before I do so, Greg, I don't know if there's anything you'd like to share.
No, not at all. Could please go, just in the interest of time. I'm good.
Okay. Yeah, I know. Once you get me talking finance, man, it's hard to get me to stop. And so my thoughts are, certainly if you have any questions on any of this material, now is the perfect time to post them. And we really want to ensure that we address any and all questions that you may have. And so, Greg, I'll be sharing my screen. And so if questions pop up, please feel free to go ahead and jump on them.
We'll do. I'll monitor.
Okay, and so here we at www.wellstack.us. Big shout out to Bunker Labs, Sam Peterson, my homie, my client here right on our main page. And then we're going to sign in to VetCap directly from the WellStack page. And so one of the great things I've seen here is that I got a Navy co-founder, and when Army and Navy work together, man, I mean, like, it's amazing. It really is. And so it's just been tremendous. We've been putting all of this together in the back end over the past few months, and it's just been tremendous. And what we really look to do here is to automate the investment banking process so that it becomes easier. We leverage machine learning, AI, chat GPT, so that we're able to get the information uh, to the right hands. We gather info like, what is your industry, what is your sector, what are your different attribute types, are you a veteran-owned business, small-owned business, B2C, and then we use this information in order to effectively match you with the right type of partner. And so it's been really exciting, certainly as we're in the midst of everything that we're seeing here with ChatGPT and with machine learning, is our ability to leverage and use these tools. And so that's just been absolutely amazing. And so we're using these pieces of information to sort and to allocate where people should go. And so I can tell you that a lot of the reason why it's so hard for Goldman and large investment banks to work with earlier stage businesses is that this takes so much time. You wouldn't believe how much time I spend building models and doing all of this. And so it's just so exciting to be able to see all this information and enter it directly in the database. To talk about what are the different strategies that you're looking, what percentage of your company are you willing to sell at this time? And so for us behind this, we've got over 200 allocators. And so depending on what you say and how you answer these, um, we're able to use that to get you connected with the best and right person. Here we have the ability to, and this is my favorite part, now my clients can add their own income statements. It's like hallelujah. Versus the parsing through quick book output financial statements. You're able to do this, and so in doing so, now again, you're saving so much effort, so much time. I can use this information to actually match up with allocators on the back end. We have some allocators that are looking for businesses with over $5 million of revenue. Some allocators have no limit. Some allocators are at $50 million of revenue. And so again, we're able to do so many things there. And then we are also really bringing education as well to the veteran entrepreneur. We organize classes and we're teaching courses so that you're able to learn all about all the different ways to access capital, really figure out all the terminology in every single step of the process.
There was a question that came up that I think you could probably handle pretty well, Andrew.
Okay.
It's from Haley McLean Hill. She's running a clothing manufacturer, is looking for inventory funding, marketing funds, and needs to hire some people, doesn't want to give away equity. As a female veteran, what kind of funding is she probably looking at? I did ask back to see what the revenues were, which is usually the first question.
Yeah, absolutely. So certainly you've got the assets of the inventory. Potentially you may have contracts, right? And so contracts are a financing asset, and they're one of my personal favorite financing assets. It's something that people often aren't thinking about. You don't think about, hey, I have contracts with this business and I can use this to get money. But at its most extreme, there's a company, York Satellite, and I was talking with UBS Investment Bank. Again, sorry for mentioning.
No, you're good. We're not the right fit for everything.
I don't want to upset you. And so I was talking to UBS Investment Bank, and he shared with me that York Satellite, which is a British satellite company, had been able to raise over $100 million from PIMCO at 8%. Now, granted, this was a year ago, at 8% using just the signed contract from the government. So they were 5-6 years away from revenue, but just that contract, they were able to get financing at a great rate. And so I'd say if you have contracts with your partners, those are going to be great. If not, if there's inventory, then that also works, as well as receivables. And so I would definitely start there. Now, oddly enough, believe it or not, many businesses that the contract person may not care and may be happy to give you another year or two on your contract. It may not matter to them. And that additional time, by the way, is extra money, extra borrowing capacity for you. And so if you have a contract with a partner and they go, look, we're going to do $5 million a year, it's 3 years, that's $15 million. I have lenders that will take that and will give 60 to 70% financing against it. And that's actually relatively covenant light, meaning it often lacks a lot of the financial strictures that you might see in other types of debt. So I would start there. After I started there, depending on your size, I would look at SBICs, which are small business investment companies. And so SBICs borrow money from the US government and they get a pretty good deal. They get 2 times leverage at treasuries. So meaning they have to raise, say, $30 million, $25 million. The US government will give them, if they have 25 million, another 50 million at the current rate of treasuries, with the requirement that they invest and lend. They do both equity and debt, with a requirement that they invest and lend a portion of that to certain disadvantaged groups, which includes us as veterans. So you got SBICs and CDFIs, community development funds, or where I would go as well. I go local for those. So I'm not sure what state you're in, but I'd go, okay, well, what are the CDFIs that are active in my state? Which are the ones that I can speak to? Where are the SBICs that, again, depending on your size. Now, SBICs like you, they liked, so there's a sliding scale, private credit at the Ares level, $40-50 million, down to SBICs will be $2 to $5 million on the smaller side, sort of thing. So it's all private credit, but these guys will go smaller. And so I would look at those as well. Now, yeah, I don't know the size of your business. If you're doing $200,000 of revenue, you're not going to be able to get a $2 million SBIC fund. But if you're doing $3 or $4 million of revenue, then you certainly would. So, somewhere between digital lenders, contract finance, CDFI, SBIC, somewhere in there, you're going to be looking, I think, pretty decent. Hopefully that was helpful.
Yeah, I have not heard back what the gross revenues are. Oh, hold on, I do. I think I've got others. Looks like about 200,000 right now.
Okay, 200,000. Then I certainly would be starting with digital lenders. I would start with one of our partners, Lendio, and they're awesome. They have 75 different capital providers within. And look at this, I love Greg. They got Greg, my man, handling the questions, screening them. He's screening them, he's setting them up, and I'm shutting them down. And so we have a great partnership with them. We have a team of about 3 or 4 people. And so they'll talk with you. They'll offer you inventory financing from amongst their partners. Other than these guys, I've got a few others that could make sense. Now, but I really would start with, do you have any contracts that are there? What I would encourage you to do, I don't know which types of stores you're selling in exactly, but big box national retailers love working with veterans. They love it, absolutely love it. And so, you've got the ability to use that to get scale. And so that's certainly something I would encourage you to do. You might be looking at Kroll's, at Macy's, at any of these people, even though you're very early. If you weren't a veteran, they wouldn't consider you. But if you have a quality product, and I expect that you do, we tend to work really hard in general in the veteran community. We may not always be the best marketers, but we tend to work really hard to make quality goods. So if quality goods, getting in front of the right buying rep at some of these large boxes, you just might get a break. And I certainly would encourage you to spend 5-10% of your time kind of doing that. Now then you'll have a $2-3 million order, and I've seen this happen a bunch of times. You'll have a $2-3 million order, and then we can take that order and take it to same partners and other partners and get the financing around that. But that would be my thoughts, sir.
And by the way, Andrew, Haley has confirmed she's also a good marketer too.
Oh, cool. Okay.
Even as a veteran. So
okay, I stand corrected.
Don Tran's looking to know if either of us have any view on the VC and PE private equity markets right now for kind of pre-seed round of funding. He's having difficulty with that, better success with angel networks at the moment. So the way that I would say that is, I think pre-seed right now, it depends on a lot of the details, like what the space is, how big it's become, if you've got sales already, if you're EBITDA positive and those kinds of things. But if it's really pre-seed, like very, very early, like sort of idea level, Andrew, I'm sure you have some thoughts. Maybe SBA loan is a good place to start. But when you're looking at those, I think you're right. At least from the tone of your question, it doesn't sound large enough for a VC or a PE firm to, certainly not a private equity firm, to look at. And the angel networks are a great place to start, as well as obviously friends and family, depending on what your network looks like.
Yeah, I think VC's in chaos right now. And the dirty secret about VC is that all the quick and easy VC raises are super incestuous, which it sounds like you're not, which we're not, because we spent our youth defending America, not interning at Microsoft or, Facebook. And so we don't have a firm-baked network of people that we worked with 10 years ago that are now at VC firms that are just ready to give us money the minute we raise our hand. And so that means you're going to have to get to know them. You're going to have to build relationships. You're going to have to start. And right now they're having a pretty bad time in general, which isn't to say that, they're not doing anything. It's just that they're doing things that are really safe. ChatGPT's E-round, that's really safe, right? And they're doing things with people they know really, really, really well. And so the risk you run is that you won't have the ability to get anything done. I would absolutely focus on the angels and the family offices. What I'd like to do is find out who's invested in companies like me lately. That's a very, very, very first thing I ask. Who has deployed capital in the last 90 days to a company like mine in size, category, and focus? And how do I build a list of those? How do I create that list? And then I start exclusively focusing on those. Yeah. I want to, before we get too far in this, give everyone the opportunity to sign up for VetCap. We've got a really special 60% off temporary discount available with a code of 582360, because I like numbers, and because it's May 8th, 2023, and it's 60% off. And so for a very limited 3-day period of time, you can get 60% off signing up on the VetCap platform. We'll be following up with it as well. But it's incredibly exciting, and we're really looking forward to partnering with you as we go through. What is our next question?
This one is really just this is from Andres Hernandez, standing up a VC fund focused on climate tech, Marine Corps veteran, and looking to partner with family offices that like working with veterans, and see if anybody has any advice. Certainly, Andres, if you wanted to shoot me an email, you and I can connect and just sort of brainstorm on that. I certainly know a few very wealthy former military folks that could potentially fit that. But I'm at gregory.blake@gs.com. Happy to brainstorm.
Cool. I think next, I know we see Rod. And so Rod, I saw that you're being offered $3 million. Yeah, look, I mean, a lot of that is personal. It sounds a little low. You know, 1 times revenue is not unreasonable for when they're really small. But if it's healthcare and there's any growth at all, then my gut thinks it should be probably be a multiple of revenue. Now, healthcare is big. It's everything from we distribute surgical gloves to we have technology that people need for surgery. And so your valuation's really different at $2.5 million for both those business models. And so, you know, that would be the thought. But, you know, generally, and if you are technology based, 7 times is a good starting point. And if you're growing really fast, it can go higher than that. If you're more commoditized, it can be 0.5 to around 1. It's kind of a, now that's really wide, but I think it's a good starting point to kind of think about things.
Yeah, and I might add on to that, just without numbers involved, but subjectively, people that approach you on a uninvited basis never have the best valuation. It never winds up being the best valuation. That's why they're doing it. It's just like those weird places that call you and offer a ridiculously low price to buy your house. I think engaging with someone who can go out and actually have a network, get multiple people interested, might be a better road.
And so, yeah, that's a great point. You know, Rod, you can certainly create an account on the VetCap platform for free. You can start to upload your information, your financials, everything that we took a look at today, and then we can start to see who could be a potentially good match, and then see what your options are there. I think that's a good low risk way to kind of get an idea. And I'll put in the chat again our code 582360 for 60% off. See, if I was a good marketer, I would have done that at the start of the call.
One last question. I just missed this from Don. Do you do at Wellstack do any networking events with potential investors?
We don't do any yet. To do a conference and starting to do meetups. I leverage a lot of events on the back of tremendous organizations, Warrior Rising, Bunker Labs, Vets in Tech. And so by going to all of their events, it's about like 15 or 20 a year, if you add all of them up, right? And so that's where I've been able to really connect with a lot of people. But, you know, I've been giving a lot of thought to, oh, maybe Goldman can sponsor this. I need a New York office to host an event for probably 50 or 100 people, veterans and financiers. And so let me know if you have any ideas, if you know any New York-based financial firms.
I know a guy.
That
Yeah, let me know.
okay, yeah, I was thinking late summer, early fall. And so thank you very much for asking the question, because now there will be one. Cool. What are our other questions? I know a lot of people had to go at the end of the hour.
Yeah, that's it for the questions. So I think maybe we wrap.
Well, I don't want to miss 2 planes in one day, so I guess I should probably get going too. Greg, I can't say thank you enough. This was an absolutely wonderful event. I know based on these questions that there was a need for what we were sharing here today, and people valued it. And so really happy that we're able to help, really happy that you were able to help me help. And so thank you very much.
Yes, sir. Thanks for having me be a part of it. And thanks everybody for being here with us and sharing the hour.
Cool. Thank you all. Take care. Talk to you soon.
Yep.